we, as investment professionals, including Merriman, who I'll get to them next, but we make these assumptions and then determine whether or not the fund is in fact funded enough. And the terminology is either it's underfunded, where based on these assumptions they don't have enough money, or it's adequately funded, or overfunded in some cases as well. And every 2 years, the city of Lewiston hires a company called Milliman to determine whether or not there's enough money in this pension fund. And so Milliman takes all these variables, the number of participants, what's happened in the last 2 years, what the rate of return was for the investments, and then changes to other assumptions as well to determine whether or not there's enough money in the fund that we are managing. What I have in front of you, can you see this where it says Milliman? Yes. In the upper right? Okay.
Yes.
Yes.
This is just a page out of their report dated the end of September of 22. These normally come out in December after they do their computations. And you can see that this is done every September 30th, every 2 years. I'll go to a highlighted portion here and what their conclusion is based off of all those variables. And that is that the plan has a funded ratio of over 100% as of the end of September. That is a great sign. And it comes from performance. It comes from changes in many of the assumptions that were beneficial to the plan, as well as a few other items. Sometimes cost of living comes out higher than they anticipated. That bumps up the required income. And you can see here that the assets, our responsibility is to, you see this asset return, 5.75% is our bogey. That's what we're shooting for, or that's what we need to provide to contribute to our to the funding status staying at 100%. And then this next line that I have highlighted here, we don't know how things are going to unfold. We don't know if our returns will actually be greater or less than that 5.75. We don't know what the cost of living increases are going to be. And then the mortality experience, meaning are people living longer or not living as long based off of the actuarial table. So all these things come into play when determining whether or not we have enough money to continue to fund the pension, or to continue to fund the pensioners. So as it stands right now, as you read, we do. It's 100% funded, and that's quite an accomplishment. The performance has been there, not so much in the last couple of years, but we have had good performance. And there's been some additions to the fund by the city to make sure that those pensioners are taken care of. Any questions so far about the funding status? I don't claim to be an expert in funding, other than knowing that you are fully funded, and I know the variables.
I have a quick question for you, Jeff.
Yeah.
So how low would you let the funded portion go down before you would recommend an increase in the ADA?
Yeah, that's kind of out of my realm. I mean, I know that there's a number of underfunded pensions out there. That's just out of my area of expertise as to how low you can go.
You don't want to go too low, or you have to start doing disclosures to all of the retirees. So it's really a question for Milliman, but you definitely want to be above 90%. Otherwise, you get into having to do disclosures to all of the participants and beneficiaries.
Oh, you said, okay. So 90 sounds like a bogey where, there start to be some alarms going off.
Well, I think it's less than that. I just like to say 90. I think it's more like 85.
Okay.
I always put a buffer in there.
Yeah. Okay. Well, now here's the situation where we're at right now and how we manage the money. Think about the last 10 years where we need to produce 5 3/4%, or we want to, where interest rates were. Interest rates were close to zero for most of the last 10 years, excluding the last year. So we were somewhat forced to be more heavily in equities going into the stocks in order to produce those returns. Um, and overall, it's worked. I'll show you a chart here as to how our performance has been over the last several years, and also since the last measure at the end of September. These longer term charts, you can see the last 3 years through the end of March, through the end of May, just under 7 net of all fees. The 5-year number is at 6, 10 years at about 6, 20-year is over 6. And so the numbers have been doing pretty well. If you look at the equity percentages here, meaning the stock performance, we've had 10s and 8s. There's another 8, and there's another 8. So between 8% and 10% longer term has been the performance of stocks. Whereas if you go down here to fixed income, and I'll look at this this bond index right here, which is the measure of the overall bond market, you can see for the last 10 years, for instance, it's only 1.27%, and we need to create 5.75. It makes so much sense that we've been heavier into equities over the last several years. Any questions about that so far? Okay. All right. I'll give you now the situation that we're in currently is I only have performance numbers up through the end of May, but I ran this performance through May from October, meaning when our next period of we know we were fully invested through the end of September of 22. All right, well, what's our pace since then? And our pace through the end of May is we were up over 11% during that period. And then I just did a back of the envelope with the percentage for June. We had a great month in June. Overall, since the beginning of October, we're up about 15%. We've had a really good run. And that doesn't mean that the numbers have always been that good, but the market has treated us well, and staying heavy in stock over that time has been beneficial because the stocks are what have performed so well. What's changed in the last 10 years, particularly in the last year, is interest rates have gone up. And we want to take as little risk to get that 5.75% as we can. And now we've got interest rates ranging between 4 and 5%. In the short term, you've probably seen us in your bank balances or with money market funds. We're seeing anywhere from 4.5 all the way up to the low 5% in short-term rates. Well, that resonates with me. I want to take as little risk as I can for the benefit of the pensioners to get that 5%. So what I would anticipate from me or from the portfolio is that I think it's logical that we've had such a good run here with stocks, and we have a viable option to go into fixed income, is that we reduce the overall equity exposure and start increasing our fixed income exposure to reduce the overall risk of the portfolio. Now we do give up some upside if the stock markets continues to go, but that's the trade-off. Everything has trade-offs, and so I do think it's a reasonable with the running start that we've had this period is to take some money off the table, keep that funding status as high as we can, and then just use this running start that we've had to try to stay in that fully funded status. Did that make sense? I know I have a tendency to ramble. So from here, this is our current balance in the pension fund through the end of June, and we're up at over $13 million. The pensioners draw out. I'm sorry. Did you have something? Did somebody have something to say? Okay. The pensioners withdraw. It's about $89,000 per month or a little over $1 million per year. So one of my jobs is to make sure the cash is available for those monthly withdrawals. You can see here in the middle of this page the allocation of the portfolio. How much do we have in stock? How much is in bonds and fixed income? And then how much is in cash and real assets is another category of equity. So we're just under 70% in equity, which is the maximum. Oh, sorry, go ahead. Oh, okay. Which is the maximum we can have based on the investment policy statement is 70% in equities. And I've been wanting to get as much performance out of that as I can. And so I've stayed at the high end of that range. What you'll see here coming up in the next month or so, maybe a little bit faster, is that I'll reduce this equity percentage by anywhere from 10 to 15 percentage points, and then add that to fixed income. And what that would do is that it would reduce our market risk. And we all know what market risk is because we went through COVID. Your 40 or your retirement plans probably saw at least a double-digit decline in performance last year. We will try to reduce that overall risk by bringing this down to between 50 and 55%, and then increase the fixed income portion and the cash portion, and earn modest returns, but still solid returns of anywhere from 4.5% to 5.5%.
And that is allowed by your investment policy statement.
Right.
We do have target ranges, so it's not like you need to make an adjustment to your investment policy statement to accommodate this.
Exactly. What we own now is predominantly large companies and mutual funds and individual stocks in large companies. You can see that's nearly half of our portfolio. We have a smaller percentage in mid and small size companies, as well as almost 10% in cash. Now, granted, that's earning over 5% right now, and investment grade bonds, which is earning also over 5% right now. So ultimately, I want to make sure that we're staying diversified and not taking too much risk in any one particular category, sector, or asset class. So next statement, or the next couple of statements, expect to see this equity portion drop down, and these columns to drop down, and this column to bump up. And that's all for the sake of risk abatement. Any questions so far? Any comments that you'd like to add?
I have a question on moving from equities to fixed income. Are you selling at when the market is high, or what is it you're trying to accomplish there?
That's exactly right. We're trying to, knowing that we have a target in place of that 5.75% net. The market has really rallied, and I'll show you some of the things that have done well for us. For instance, like these funds right here. This VIGAX is a symbol of a growth fund. That fund is up over 30% on the year. Stocks in general are up as measured by the S&P 500. They're up well over 15%. So we've had a very good rally in some of our biggest positions. Now, what's happened is that this is a great time to segue to some charts, and I know charts are often conversation killers, but there's some pretty good ones that we have in here. This is a really interesting chart, I believe, and that there's only, even though the stock market is up anywhere from 15 to 17% on the year, this top blue line is the top 8 stocks in the market index, and those, and I'll have them all off the top of my tongue, but call it Amazon, Google, Microsoft, Nvidia, Tesla, some real high flyers in there that have driven the market. Those are up anywhere between 50 and 60%. What's interesting here is that the rest of the market is this light blue line. The rest of the market's down a little bit, maybe up a little bit now at the end of June. So these big names, these very growth-oriented names, have driven the entire performance of the stock market year to date. And what I want to do is capture some of that. This fund is made up of significantly of those top 7 or 8 stocks, along with many others, but they've come back. I think it's wise to take that 50 to 60% gain, or in this case, our fund is up 30%, to pare that back and say, okay, we'll take that big gain. We're out ahead now. Let's just go ahead and try to capture some of those gains, because honestly, the risk of them going down is greater than the risk of them continuing at that pace. So let's capture that gain and go into some more stable 4 to 5%ers and reduce the risk of them tumbling.
It's basically, we're trying to de-risk the portfolio, get out of having so much volatility, because you are at, you're at 100% funding. So
yeah. And volatility, you're not as concerned about it if you're 40 and it's in your 401k. But if you're trying to produce cash flow, it is an issue, because right now the cash flow that we're producing equates to over 8% of the overall portfolio value. So knowing that we've got to produce that cash, it changes things. You can't afford the volatility, or let's say you were 100% stock and the market was down 20%, you'd be selling a lot of stock when it's down, and you don't really want to do that. So we're increasing the portion of our income producing fixed income, and that should benefit, or at least reduce the risk of the decline in the pension fund. So yeah, I think I just covered that. Up 15 year to date, averaging anywhere from 6 to 7% when we add in the 4% for June, and reducing the overall equity exposure. We've done decently compared to our indices. We have taken a more conservative path, yet at the same time, when you have a diversified portfolio beyond those big winners, you're likely to underperform. You notice the mid cap and the Russell 2000, which are measures of medium size and smaller companies, they haven't done nearly as well as the big boys have. But that said, for instance, you never know when things swing. Today, small cap companies were up about 1.7%, and the big names were only up about 0.2. So you had a 1.5% swing to the small companies on days like today. So we do have smaller percentages in the mid and small companies, but the vast majority of our assets are in those large names. And another note on this is that we've really done well on the fixed income side. If you look at the blue line versus the benchmark below it, for instance, on the 3-year number and the 5-year number, we're almost a full 3 percentage points better than the index on the last 3 years, and about 1.5 percentage points per year better on the 5-year number. So I'd say I'm confident we've done well for the portfolio. It's just that things are changing on how we should manage it, and that is in this case where we bump up the fixed income. Okay, well, another why do we do what we do? And I won't get into all of this, but this is a fantastic chart as to why you buy stocks. This is the S&P 500 going back to 1943. And you can see that it's a pretty steady increase. You would want to be a part of this in your investments. But when you zoom in to these red lines, those are the scary times when you can have a really significant sell-off, for instance, back in 2008. Boy, did that ever sting. But if you would have held on, look at how steep this has been coming back. Now, in order to stay in equities, you have to believe this is going to continue. And I do believe that. Warren Buffett has a great line where he said, America works. And I love it. I love Warren Buffett. And when he says America works, I think he's saying that this chart is America working, where it continues to grow despite all the noise. There's always going to be a reason not to be in stocks. But I think for the benefit of the pension fund, it still makes sense to have half of your portfolio, half of it in equities, because think of the scenario in 2 or 3 years. Let's say that we went 100% conservative and bought some bonds that mature within 3 years, and then interest rates fall back down to 1 to 2%. Well, you're in a real mess at that point. Suddenly, you're not earning anything. You haven't had stocks to help offset the performance, and you're wishing that you would have stocks to help grow over that period of time. So sometimes I'm asked, why don't we just go completely fixed income? That's the reason. We'll reduce our equities, but I still think because this has to last another potentially 20 years, if not longer, we still want to make sure that the money is going to be there through all different types of interest rate and equity environments. So going forward, I think I summarized it pretty well. We are fully funded. Oh, sorry. Yeah. Did someone have a comment?
I have a question.
Okay.
Oh, yeah, we have a question here.
Yeah.
How do we compare
Please introduce
to
yourself, sir.
Alan Johnson? I'm retired law enforcement. How do we compare to Percy?
You know, I should have checked that, and honestly, I just didn't check it. I apologize for that. I don't know if they're how they're comparing to the S&P 500. If they're broadly diversified, where they have a lot in mid and small, they'll look a lot like us. They also have private equity and private debt, which can be very scattered. So private equity didn't have a great year at all last year, but I just can't say how well they've done. And I apologize, I wasn't ready for that number. I'd be glad to check and see how they've been doing. But it is something that I'm interested in finding out. I would say that we're probably pretty close because they're not in the business of taking excessive risks either, and that's kind of what we've been having that same mindset. That was a really long way to say I don't know, wasn't it? Sorry about that.
Thank you.
But I would expect them to be similar. Okay. So final summary on the pension plan. Fully funded. We're way ahead of the game we're way ahead of the game, being up 15% since that last measurement. And because interest rates have gone up so much, look at me to take some of our big gains and not completely get out of equities at all, but just take some of our big gains and lock in some more solid rates, less volatile rates of that 4.5% to 5.5% range. But if I am a pensioner, I feel really good about this news that the funding status and the fact that we're ahead of the game going into the next measurement.
Percy hasn't published their information yet. As of June 30th of 22, it was negative 9.66. That's a negative.
That third quarter.
It's too soon to know yet for the June 30 fiscal year for Percy right now.
Yeah, and what happens a lot there is that when you have private equity is just that. It's not publicly traded like Amazon or Microsoft or commonly publicly actively traded stocks. And so they've got to come up with pricing. What are their values? Well, that takes a long time to come up with those values, and so they end up being really tardy in their performance numbers when they come out. We don't have any of those in here, and so it's really easy for us to come up with performance numbers quickly. I can say that private equity can really be great, but it can also be really terrible. I think the range of outcomes for private equity, if you can hit the good ones, outstanding. If not, you'll have wished you just stuck with the old reliable traditional publicly traded stocks.
So just to add, so this is through June 22nd, 2023. Percy Fund was up 8.6%.
Oh, for the year?
Through June 22nd. So they're a week or so behind.
Oh. Okay, so we've been, I don't have, yeah, I went back to the September numbers. I don't have the year-to-date numbers, but I'd say that we're pretty much in line there. But I don't have the year-to-date numbers in front of me for this, but that sounds about right for us.
Well, and that would be based upon Percy's year end is June 30th, so that's from 7/1 to June 22nd versus this plan is from 10/1 through, what did you have, through May?
Yeah, 10/1 through May, and I did that because that's when the last.
15 through June. Yeah.
Okay, I'll just take. I won't spend as much time on the perpetual care fund, but we have about $1 million in there. I keep some in cash because I never know. And talking to, was it Tim?
Mm-hmm.
Yeah.
That could change. I don't know if Tim's still there.
Okay.
For today, I am.
Oh, great. Very, very similar the way we run it. We've got an investment policy statement that gives us the same range as the police pension fund, where you have a maximum of 70% in equities. It doesn't look like we've taken a withdrawal out of this account for a while. I will look back to March of last year, and we haven't had any withdrawals. Normally, I'm ready for anywhere from 40 on a yearly basis, 40 to 50,000 on an annual basis, but either it just hasn't been needed, or the funds have been taken from other sources.
And I think there's a percentage of income that they draw on this when needed. So
yeah, but it's there, and same type of story here with cash and fixed income. I'm comfortable having 7.5% in cash because we're getting over 5% on that. And we still have plenty in equities. I'm not as eager to reduce this equity percentage because it doesn't have the cash flow needs that the police pension has. So if you believe that equities are going to perform longer term, I'm not likely to bring this. I could still bring it down some to take some gains, but we can absorb the volatility more if you believe equities are going to outperform the fixed income and the cash, and I do believe that. So I haven't done a lot of rebalancing with this, but you can also see that same type of allocations here, where we've got most of it in most of it in large companies, a significant portion in investment grade bonds and a money market account, with smaller amounts in mid cap and small cap securities. So similar numbers performance wise. This one I put a couple of funds in here that haven't done as well, and they've absorbed they were more growth oriented, and it's affected our 3 to 5 year numbers. I'm anticipating those coming back strong. This year to date number, we're up. Our stocks are up about 9%. Up about the count is up about 10% through the end of June. Not as good as the police pension fund, but it has been recovering. The weaker performing funds that I'd mentioned before, one of them is up over 50% for the year, and the other one is up about 22% for the year. So we'll need that outperformance to continue to come back, but that explains some of the underperformance versus the police pension fund. as far as overall stock outlook, I'm not a real big believer in the accuracy of outlooks. My common line is, let's go read all the dozen or so, or the dozens of investment outlooks that are out there, so we know what's not going to happen. And it just turns out to be true. There's always something that interrupts the pace of growth in the stock market. But right now, if we look at stock valuations, it's very, very normal. Stocks are not incredibly highly priced right now. I would say we're right at the norm of the prices versus the earnings that companies are making. This chart that I have here in front of you, everything to the right of this vertical line is stock market.
You're not sharing your screen, Jeff.
Oh yeah, I'm sorry about that. Because it's really interesting, trust me. All right.
Let me see your talking points.
Oh, talking points. Yeah, wrong one. Okay. Sorry, guys. Stop sharing. Do one more time. There we go. All right. Did that work?
Yes.
Mm-hmm.
All right. And I'll finish up here with just a few statistics as to why we're at least mildly optimistic about the markets going forward. We have started to see inflation subside. It's still an issue, but we are seeing prices come down somewhat on goods, not so much labor. Labor has been very stubborn before it's come down, but we are starting to see the overall inflation numbers come down, and the market is really like that. This chart that I wanted to show you was that 2022 was truly an anomaly, where the stock market performance is all here on the right-hand side of the positive performance on the right-hand side of this vertical line, and the bond market performance is above or below this horizontal line. And you can see how weird it is, or how unusual it is, for both to be down to this extreme. And 2022 was just a terrible year, and just hasn't happened that badly where both categories were down so much in 1 year. You can see now both are up slightly year to date. I already showed you that chart. This is just a chart that shows this is the average multiple of stocks over time, going back to 20 plus years, and we're right at about average. So what this tells you is that we're really not concerned about stocks being overpriced, even though they've had such a good run. Now, this is a broad market. I'm comfortable and say, well, then Jeff, why are you selling some stock? Well, not all stocks are the same. I'm selling the ones that are way up here in forward multiples, and holding on to the ones that are down there. So as a group, though, we're not inclined to throw out a warning or the proverbial shot across the bow that stocks are overpriced.
We just don't want to see your portfolio go through another 2022 when you're at 100% funding. And if you're down 20%, now you're really underfunded again. So
exactly,
that's one of the reasons Jeff is recommending de-risking the portfolio, or basically taking on a liability-driven investing model, which is what a lot of actuaries and investment consultants do when plans get to be fully funded.
Yeah. So yeah, I'm optimistic. I'm happy for the city, happy for the pensioners that that funding status is where it is. I'm eager to take advantage of the market rally and reduce some risk, and looking forward to making sure that that money is there in perpetuity for those 30 pensioners.
questions?
Thank you, Jeff and Jenny. Counselors, questions? Don't see any questions here. Thank you both for zooming in. You're welcome to stay and listen to the rest of the meeting if you'd like, but otherwise we're going to move on to board member comments and other type items. So your choice.
Terrific.
Well, thank you.
I'll sign off. Thank you so much. I really appreciate your time and your business.
Thank you.
Thank you.
Thank you.
Hey, counselors, next up we have agenda item 3, unfinished and new business. Item 8, board member comments. I think we have a couple, huh? Serves on the board, Counselor Schroeder.
What board? I'm sorry.
You go to the meetings as a committee member appointed or?
Me. One of the ones I'm on.
Amy? What's the status of the finance committee?
On the police retirement board,
Yes.
I don't know. I'll have to look up if if they have scheduled meetings or not, or I know a couple years ago they were really active, but they were redoing the investment policies. So I don't know. I'll have to look and see if there's something within their bylaws that requires annual meetings or
Okay, yeah, or if
regular
there's anything
meetings.
we
I'm
need
not
to do
aware
with the council,
of
yeah.
that though.
Okay.
Okay.
We have one in February.
That you did have one?
I thought so.
If you did, I did not attend that. I don't recall there being one this year.
Okay.
But I'll look and see. If we need to have one, we'll get one on the schedule.
Got an update on that.
Yep.
Ready, well, staff comments, I think we just had them. So with that, if there's no further questions, comments, I would entertain the motion to adjourn.
Make a motion to adjourn. Second.
By Councilor Schroeder, Councilor Forsman, second by Councilor Schroeder. To adjourn, those in favor, please signify by saying aye.
Aye.
Opposed, motion carries. We stand adjourned. Thank you.